Bloomberg Audio Studios. Podcasts, radio, news. You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
One of the top read stories on the Bloomberg Terminal is about Morgan Stanley and cutting about 3% of its workforce pretty much across all of its business lines. And the one question I have, I think a lot of folks have, is this something specific to Morgan Stanley? Does it signal weakness in the biz? Or is it just kind of the annual culling of people? So let's just see what's happening here. Herman Chan, senior analyst for U.S. banks, joins us here in our Bloomberg Interactive Broker Studio. So what do you make of the news, Herman, coming out of Morgan Stanley about laying off about 3% of its workforce?
Yeah, that's right. 3% of its workforce, about 2,500 workers. I would say that it is sort of an annual culling. They did a similar workforce reduction last year. I would also point to the fact that headcount across the big banks was pretty stable for banks like JP Morgan, Bank of America, Citi, whereas Morgan Stanley grew their headcount 3% last year. So now they're sort of back in the pack with this workforce reduction.
So we noticed that the cuts hit investment banking, trading, and the wealth management. Mm-hmm. You mentioned that it's annual culling, but should we read into whether this signals a broader shift for the bank?
Yeah, it's interesting because last year when they did a 2% reduction, they didn't really touch their financial advisor force, whereas this year it seems like it's more broad in scope. So I think there's just maybe some changes in where they think that their advisors are, and maybe just shifting geographically as well.
You know, what are the investment banks saying about AI and as a way to make them more efficient, maybe with less headcount? Because I think about the first 3 years of my investment banking career, pretty much everything I did, running earnings models, LBO models, pitch books, pretty much all of my life could have been done by AI. I think I'm pricing myself out of a job back then, but what are they saying these days?
Yeah, so AI is a big story. We just heard JP Morgan at the Investor Day talk about the benefits of AI in terms of personalization, pinpointing which customers would be open to different products and using AI to better use their marketing dollars for that. On the other hand, they've also talked about improving customer satisfaction with the call centers and the like, where there's less people in the call centers, which is expense saving for banks like JP Morgan and B of A, but they're also improving customer satisfaction. You can see that improving over time. So there's a double benefit on that front.
But is AI accelerating structural change when it comes to these banks? Because we've heard a lot of banks and fintech firms like Block actually citing AI as a reason why they're culling their
workforce. Yes. I wouldn't say we're going to see 40% job cuts from JP Morgan or B of A at this point. But I would say that AI is definitely reducing the need for headcount. And we've seen that given the fact that JP Morgan's headcount numbers are flat year over year. And really, they've been reducing their workforce within the consumer bank, which speaks to what I was just saying before with the call center.
Yeah.
You know, we were just talking earlier that 2026 could wind up being a monster year for IPOs. We're just talking about Anthropic, OpenAI, SpaceX. What are the banks saying about the prospects for IPOs in 2026?
Yeah, that is something that heading into the year, a lot of the investment banks were really enthusiastic about a pickup in capital markets issuance and activity, specifically with IPOs and equity capital markets, and also in M&A. You talked about some of the three headline IPOs that could potentially hit this year. That being said, there's been some volatility and turbulence in the markets today, so maybe that pushes things back a little bit. But overall, there is some general enthusiasm. And JP Morgan mentioned capital markets would be up about mid-teens for the first quarter. So there's hope that could continue going forward.
Do you think that these layoffs will affect Morgan Stanley in competing with top talent? Because to Paul's point, it's going to be such a busy year, or is this par for the course in most banks?
Yeah, I would say Morgan Stanley is one of the top investment banks, particularly in technology, TMT, and they're going to get their fair share of deals and win a lot of mandates. Just given the fact that they have really strong banking presence within that industry, we'd expect them to do really well in 2026.
You know, when President Trump was elected and took over in early last year, one of the industries that was really thought to benefit would be the financial services industry. Much less regulation.
That's right.
Rolling back some of the regulations that came out of the great financial crisis. Have we seen that?
We have. So we've seen that directly with M&A, with bank M&A. There's been more deal making, but also less red tape in terms of getting deals approved by the regulators. We've seen a few deals that just get approved with less than 100 days from announcement to close, whereas during the Biden administration, it took 300 to 400 days for that to happen. So much more streamlined. And you're also seeing, on the other hand, for the big banks, less onerous capital rules. So that means they can plow more of their capital into the trading businesses and lending. So that's going to be an ongoing benefit for the big banks.
Stay with us. More from Bloomberg Intelligence coming up after this.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Broadcom, the chip maker Broadcom, reported some pretty good numbers, better than expected numbers, some good revenue guidance. CEO's talking about $100 billion in revenue next year. They had about $68 billion last year, so that's a mega jump. Let's check in with Kunjan Sobhani. He's a senior analyst covering the semiconductors for Bloomberg Intelligence. He's based out there in San Francisco. Kunjan, seems like a good number to me. What did you guys and what did the street take away?
Yeah, it was one of the most strongest showings when it comes to AI chip names in our sector. Just for context, most other AI chip names, despite them giving strong numbers, next day have seen their stock down sort of mid-single digit. Here you're seeing the opposite. Very well justified. Few things that really stood out to investors. That one was the 100 billion plus line of sight of AI chip revenues in 2027. And to add the point that they see growth in 2028. Again, this is the first company calling out growth 2 years out so far in our sector. So that should ease the concerns around hyperscale spending. There were a lot of other good points here. The networking side of their business, which we believe continues to be underappreciated, has been running much faster than people expect. The gross margins, which you would think should be seeing headwinds because of these ramp of their AI chips, are actually going to stay stable, which in itself is a very positive sign, which implies that they have significantly strong pricing power. They're not eating the rising input cost, and that they have the supply chain really optimized to get the best yields.
They did say that AI sales chips could top 100 billion by 2027. Kunjan, how credible is that target? I mean, AI revenue more than doubled last quarter, but is this growth sustainable?
Look, what Hock says in our sector is not taken lightly. It's sort of a line in the stone. So I wouldn't think they would be throwing out numbers willy-nilly if they didn't have to. Also, there is no need for them to throw out that long outward number. So, most of the street and the sell side does give a lot of credence to that number now that it's coming out from Hock's mouth. And look, when we look at the gigawatt and the unit volume projections, which are there on the street, even before that 100 billion number came out, it doesn't seem drastically aggressive or ambitious. I mean, we have heard Google's higher capex, the Anthropic deal and the OpenAI deal lay out the timing. Anthropic, again, to remind everyone, will be on all the TPUs that Broadcom creates through Google. So when you add up most of the unit volume which is expected, this does seem reasonable that they can easily achieve that 100 billion target.
Kunjan, where does Broadcom fit into the world of the semiconductor chip makers? I'm thinking, versus the Nvidias of the world, the AMDs of the world. Where does Broadcom kind of fit in there?
Yeah, so the AMDs and Nvidia sell what we call GPUs. Think of them as AI accelerator chips used for everything AI. But that is something that off-the-shelf chips, anyone can go buy the GPU and use it the way it's supposed to use. Broadcom sells a similar chip that is used for the same AI training, AI inference, agentic AI use cases, but are ASICs. What it just means is big companies like Google, Meta, Amazons, and Microsoft go and sort of design their own AI GPUs, if I may, working with a company like Broadcom because they want to modify, they want to customize, they want to optimize it to their own needs. So essentially, you have the NVIDIAs, the AMDs, the Broadcom, and the Marvells all selling AI accelerator chips. Is just the end use case is the same, it's just the mode of execution is slightly bit different.
Broadcom also announced a $10 billion buyback. What does that signal to investors right now, in your opinion?
It's definitely a positive signal. I mean, any buyback is a positive signal, but it is not that huge enough to really raise eyebrows. Broadcom historically has been a great dividend payer. They have sustained records of growing their dividends. So that is what their sort of long-term capital return shareholders really care about, which they continue to still do. This is just a cherry on the top.
So Nvidia, they have an investor day coming up, I believe, on St. Patrick's Day. What do you expect to see there? That could be a big data point.
Yeah, that usually is a huge data point for them. It is their 3-day conference. Look, we expect a couple of things here. We expect the new sort of a lot more details when it comes to their Vera Rubin, which is supposed to come in second half of 26. And more than that, we expect a lot more details on their 2027 roadmap. All eyes are from investor perspective now that what we have heard from Nvidia, Broadcom, and every hyperscaler is really to figure out the 27 numbers. So the focus really will be the chips that are coming out in 2027, the new innovation that they will be doing, what will be the memory, whether it will have silicon photonics, CPO. I know I'm rambling some technical terms, but this is what will really help investors to shape 2027. Will 2027 be an up year for chip makers? And does that mean the hyperscalers will still keep spending more in 27 than they are spending in 2026, which would be an impressive feat? So that is what really the focus will be from NVIDIA's GTC.
Kunjan, 30 seconds left here. How often do I have to replace a chip? Is that something that I have to do every year, every time they update? How's that work?
Yeah, these are fairly new chips. So when you think of, we have not seen a full life cycle of these new GPUs and ASICs, right? We really started seeing them deploying in volume in 2023. Now, based on the depreciation schedules right now that are put in place, we're talking about 5 to 6 years before you really have to crank out a chip and put a new one in its place. So we are not there yet. However, there's another business case where you have a limited power, you have limited data center footprint. So if a newer, more efficient chips comes in, there might be a business case to justify ripping out an old chip, even though it's working correctly, so that you are running on the latest and greatest chip.
Stay with us. More from Bloomberg Intelligence coming up after this.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
One of the themes or one of the storylines around AI has been the use in the government, particularly the Department of Defense. A lot of these AI folks are having discussions with the Department of Defense about how the technology will be used. One of those is Anthropic. And Anthropic, the news today out of Bloomberg News, has resumed discussions with the Pentagon about the use of AI models in the U.S. military. Let's check in with Mandeep Singh here. He runs the tech research for Bloomberg Intelligence, joins us live here in our Bloomberg Interactive Broker studio. So Anthropic back into discussions with the government. How is this going to play out, do you think, with these AI agents and the level of control they may or may not have about how their technology is used by their customers, in this case, the U.S. government?
Yeah, I mean, I was very surprised that they didn't come to an agreement before, and they were designated as a supply chain risk, which is a big deal for any entity, any company operating here in the U.S. So from that perspective, it's good that they are back to negotiating with the government and trying to figure out a solution so that they don't end up losing any business. I mean, Anthropic just doubled their revenue in the past 3 months. So they ended the year at 10 billion. Now they are at $20 billion run rate within 3 months. So this is one of the fastest growing US companies ever. And they've been designated as a supply chain risk. So clearly, they have a lot to lose in terms of momentum if this carries on for a long time. And from that perspective, I do think, the management, especially the CEO, who has been on various podcasts talking about, the whole guardrails and the points of disagreements. I do think that they'll find a solution, and that should somewhat insulate them from losing any business.
So Anthropic reportedly wants limits on surveillance and autonomous weapons. Do those guardrails become the industry standard, or if they keep pushing for that, will they be at a competitive disadvantage? Because to your point, they have a lot to lose. And not only them, possibly most of the companies who are wanting to deal with the US government.
Well, OpenAI stepped in right away as soon as they had a fallout. So I don't know if, other companies believe in the same philosophy here. And Anthropic has, being a big proponent of guardrails and, safety, more so than the other frontier model players. So from that perspective, that has helped them, with enterprise adoption. But in this case, it's the US government. And, you go back in the history of software companies. I mean, Apple has had some disagreements with the government where they were asked to open the platform. Same thing with Microsoft when it comes to national security. And they found a way to, just make sure that the government has a good workaround. So in this case, that's what they have to compromise or, come up with a workaround. It doesn't mean you have to open your platform, but just kind of make sure that, the government doesn't label you as a supply chain risk. Yeah.
Anthropic, OpenAI, are these companies going to come public, do you think, at some point?
I mean, they are getting ready. In fact, I won't be surprised if it's not this year. Like, really, everything points to them going public in the second half, given, how focused they are on that ramp up and what they are doing in terms of just the cost structure side. Because one of the criticisms is how much cash they're burning, and the training does require a lot of upfront cash. But in this case, now that they have doubled their revenue in the past 3 months, and they're
I could sell that.
and so that's where I think it's a perfect IPO story.
2026 may have OpenAI, Anthropic, and SpaceX.
Yeah, it's going to be an exciting year.
That could be an extraordinary.
Some of the biggest IPOs. I mean, these are not early stage companies anymore. So think of how much money they may end up raising in the public markets.
Stay with us. More from Bloomberg Intelligence coming up after this.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
We got some earnings coming out. Some of the retailers, as you know, they kind of report towards the end of the season, given the holiday. They like to push the reportings back a month versus most other companies. Kroger, we had some numbers out. BJ's Wholesale Warehouse. Jen Bartash, she covers this part of the retail space. Jen, let's start with Kroger's, the biggest supermarket chain other than Walmart. How do they do?
Kroger had a pretty solid quarter, and I think investors are very encouraged by the early signs of what their new CEO, Greg Foran, is bringing to bear. The last year, Kroger's really focused on streamlining the business. They've gotten rid of some assets. They've streamlined their e-commerce operations, and now they seem to be better positioned for growth. And one of the things he's known for is execution. And so there's some optimism with regards to how Kroger, could perform this year.
We're also seeing shoppers trade down to private label and hunt for discounts. Is this trend accelerating across the space, or is this specific to Kroger's?
No, it's accelerating across the space. And when we look at across all goods that are sold, private label sales are still growing at a faster rate than national brands. The pace of that growth is a little bit slower than it had been, but it's still edging out national brands. And so when you have retailers like Kroger who have a long-standing program around private label, that really bodes well for them with regards to their product mix and their ability to offer value as well as innovation to their customers.
So talk to us just broadly how the trends have been with some of these private labels vis-a-vis the established brands, just maybe like in shelf placement. It used to be the private labels would be on the, the bottom rung of the shelf near the floor. Are they getting better positioning? Because I know that's important when you're walking down the aisle.
It is. It's a great point, Paul. And what you're finding is that for some retailers, that private label is front and center. And part of that is due to the fact that in old days, the retailers were more reliant on allocation funds from the CPG companies that dictated where goods were placed. But in a new age of advertising and digital assets, the need for that in-store placement is not as big as it used to be historically. So they've got more leeway to put the items where people see them. And at the same time, from a private label perspective, there's just greater acceptance. If you think about chains like Aldi or Lidl, these are chains that are almost all private label brands, and people have really started to embrace that. And so private label in and of itself is no longer, sort of more of a taboo category, and people consider themselves smart when they're buying private label because they're saving money.
Yeah, I've been seeing, like where I live down the Jersey Shore, a ton more of these Aldi and Lidl stores. I'm like, who are these people?
Oh, really?
Now I know. Okay, because they're not the ShopRite in Belmar, so I don't know.
Let's go to BJ's. They delivered an earnings beat this quarter. Are warehouse clubs continuing to take share from traditional supermarkets? Is that the trend we're seeing?
It is definitely a trend. I think what happens is consumers, once they lock into a membership, they really look to maximize that membership. And they've understood that warehouse clubs as a type of store are actually better positioned than grocery stores or even the mass merchants to make quick changes to their inventory. And what that means is that they can always pivot to things that are the best value for their customers. So even though they may not have the exact same item every time you go in the club, people, they encourage that to be looked at as a treasure hunt experience, but they can also offer really, really good value. And so we're seeing the membership base grow, and it is eking, sales away from some of those more traditional formats.
So what is the story? What is the story for BJ's Wholesaler? How do you position it? How does the street position this story?
So BJ's has done a really good job in the last 2 or 3 years of reorienting to growth. They've accelerated their store openings, so they're entering new markets as well. They're entering the Dallas-Fort Worth area later this year, for example.
Ooh,
and that kind of growth and targeting high growth markets is really a good plan, because historically they've been really constrained to the Northeast. And so I think people are looking at BJ's, and they've really been able to show that those new clubs are executing well. They're very, very productive stores, and they're able to sustain a pace of faster openings. So all of those things together really point to a long runway for growth and a lot of white space to enter for new markets and to gain share.
So with inflation easing, but consumers still cautious, what are you on the lookout for when it comes to the grocery earnings this year?
Yeah, it's a great question. There are a couple of things that we're really watching. And when you're talking about food retail, price sensitivity is there, but it's going to shift more this year to, are these retailers able to sell greater volumes of goods? And if they're achieving that through price cuts or through promotions, and then how that then translates back to like the food manufacturing companies. It's been multiple years since we've seen retailers have positive volume in the majority of the store. And so that really is the focus for this year, especially because inflation has become less of a pressure for them to have to manage.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.